Welcome to today's Q&A on markets, where we certainly have plenty to discuss. I'm delighted to be joined today by Lothar, Claire and Stuart. Lothar co-founded Tatton Investment Management in 2012 and has overseen its growth to become a leading discretionary fund manager in the UK. In an investment management career spanning 3 decades, he was previously Chief Investment Officer at Octopus Investments and designed and launched the Barclays multi-manager fund range. He's also held senior roles at NM Rothschild, Threadneedle and Commerzbank Asset Management. Welcome, Lothar.
Thank you.
Claire joined Tatton Investment Management as a Director of Investment Solutions from Brooks Macdonald, where she was a Director of Services and Products, having previously been Head of Currencies and Technical Analysis at Barclays. She's a Chartered Fellow of the CISI and holds an MBA from Liverpool University. She's been a regular contributor to conferences and publications in the UK and overseas. Welcome, Claire.
Thank you.
And last but not least, Stuart is an independent economic consultant. He has worked in financial services for over 40 years, previously served as chief market economist for both investment banks, fund managers, as well as absolute return hedge funds. Previous employers include Chase Manhattan Bank, Nico Europe, Crédit Agricole, Ignis, and Standard Life. So as you'd expect, there's been quite a bit of volatility in markets. So hopefully from these questions, it'll give you some insight into the thinking from the people actually running the money in the background. So Lothar, could you give us your view on the impact of tariffs on US equities?
Yeah, delighted. Well, or not really. Well, first and foremost, up to this point, the US had import tariffs of no more than 2% on average. And with what was originally announced on Liberation Day, it went up to beyond 25%. Still is probably at that level, even now that the tariffs have been reduced back to 10% on the 90-day moratorium to most, but not China, because China has increased to 145 on average. We're back to the 20s. Why is it a problem? Why is it dragging on equities? Well, it's a massive change to how things operate. And secondly, if we remember from the pandemic, we all learned how there are international supply chains. And if you've got supply chains, it means that your goods are potentially crossing the border a few times. And particularly in North America, a lot of the things that are being sold in the North American market cross the border between Mexico, the US, and Canada a few times. And the US consumes a lot of things, or consumers buy a lot of things that come from overseas, and all of a sudden get a lot more expensive. And that being much more expensive, if you like, acts like a massive tax rise. And that, in other words, is a fiscal tightness, or you could almost call it austerity, because all of a sudden people have a lot less money in their pocket. And that then brings down activity levels, not just from the consumer, but also businesses. And all of that drags, obviously, on the profits that companies can make.
How are you managing risk, but also the opportunities for portfolios during a turbulent time like this? And what lessons have you learned so far?
Well, for one, it is a bit more difficult than usual to manage these, because there are more human factors, as we know, involved in this than normally, even more than during the pandemic, in that we know that Donald Trump can turn very, very quickly, and therefore reacting to whatever comes out is in a way very prone to getting it wrong. Nevertheless, we started the year on a slightly more nervous footing, I suppose, with US equities being quite highly valued and the future not being quite so clear. We started with a neutral position on the risk side, and very quickly became comfortable with an slight underweight to the US. But I have to say, once things really broke, and it wasn't quite so foreseeable, hence the market surprise that it would get that bad, it doesn't make much sense to try to then move very quickly. So it was better to have the portfolios well diversified, as always, positioned without particularly focal points in any one areas, and that included the US. But then to wait things out to a certain extent, which once again proved to be the right strategy, because since the lows, the markets have bounced back already 10%. So anybody who moved in panic back at the bottom would have now already missed the 10% recovery that we've had since.
Long term, it's always investors are rewarded for patience during times like this. Do you think, Stuart, that the tariffs will trigger more inflation fears than growth downside?
I mean, I think you have to look at inflation in two ways. One is a simple price rise. Obviously, an increased tariffs will lead to price increases. But inflation from an economic perspective is the continual increase in prices. Tariffs are a one-off increase in prices. And in order for those prices to stick, demand has to remain high. Now, the likelihood is that America is going to see a contraction in GDP over the next 2 to 3 quarters at the very least. I mean, there's evidence from the Atlanta Fed GDP now estimate that it's contracting about 0.3, so basically flat in the first quarter. Given the increased uncertainty, we would expect modest contractions at least second and third quarters. So that's not going to fulfill the demand, and prices are going to start to come off. For me, tariffs are deflationary, and but that will be evident in 6 to 9 months' time.
And how long do you see current volatility continuing based on those factors, Stuart?
I think the big problem is uncertainty. Trump is erratic. We don't know from day to day what the announcements are going to be. We've had tariff on, tariff off. So that increases both business and consumer uncertainty. Faced with uncertainty, we see a rise in savings. The interesting thing about the US consumer, who almost unique in the world after the pandemic, didn't raise their savings. The history of pandemics shows at least a rise in savings. Now, we may be getting that delayed effect with the increased uncertainty of tariffs. Certainly for companies, it's difficult to make long-term investment decisions when you don't know what the price of your goods, your inputs or your outputs are going to be. So again, savings increase, and that increases both economic volatility, profit volatility. So again, you go to minimum, you're looking for 2 to 3 quarters of this occurring.
Well, if I may add, the difficulty around the uncertainty is also that the US administration and generally the US system still has quite a few levers to put forward. I mean, on the one hand side, after the 90 days, we might get a message from Trump that he's won. He's been super successful in getting everybody to the table and they all want a deal, and therefore, hooray, off we go. We have got much lower trade barriers and no more need for tariffs, although I think it is consensus that they will probably keep the 10% baseline, because simply they need revenue in order to, at the same time, also deliver on their promise of cutting taxes, for which they haven't really got the funds at the moment. So there's that. You also have the Federal Reserve that should, because of all the upset that's already happened, the economy go into a contraction anyway. The Fed can cut interest rates quite significantly at the moment, and they will if they see that it is necessary. They're not going to go straight away, but there is quite a bit they could do on that side as well. And then Trump could come out and do fiscal easing if he wishes, and if the bond markets are with him, that it's balanced enough to not throw another wobbly at him. So in the current environment, it's not quite so straightforward, to our mind at least, to say, well, it's a dead certain now that the US is going to go into a contraction. All corporate earnings are going to be negative or declining from here. It's not necessarily a given. That man is so volatile, and that's the volatility we're really talking about, that you have to be quite careful in how you manage your portfolio exposures, and so it's a more difficult situation almost for investment managers than we've seen since, well, and beyond the pandemic, I would say. I don't know how you see that, Stuart.
Yes, absolutely. And if you look back to the pandemic, of course, you saw that contraction in GDP continue on, during the lockdown, and the numbers were terrible. But the Fed had come in after that, the so-called temper tantrum, where, like last week, there was a rise in bond yields as there was forced selling from the basis trade collapses, and that led the Fed to step in an enormous buying program, which stabilized confidence, disconnected markets from the economy. So it's really what sort of response we're going to get from the Fed when, if we get another tantrum like last week, just as the Bank of England did with the Liz Truss episode, the Fed will come in and buy if markets start to get unruly. The Fed obviously will respond to the weakness in the economy with lower interest rates, and so that will provide the support. And there is this suspicion that Trump has a cunning plan of weakening the economy in the initial period in order to justify bigger tax cuts. Who knows what goes on inside that orange head of his?
Well, just to go back to your point, Stuart, on the bond market and both your points. I think there was a tantrum last week, but I do think before you move to interest rate cuts, there are other mechanisms in place that weren't even touched. So you have the repo market in the fixed income, you have the swap lines. These were not touched last week. So even though there was a tantrum, we didn't get to the point of stress that would mean that the Federal Reserve would even start to look to step in at that point before you even go to interest rate cuts. I think the interest rate cuts will come through as we see, as we've all spoken about, growth falling, and obviously the expected decline in the jobs market as well. But we haven't, even though we've seen this huge shock to the market, tariffs going from 2% to a baseline of 10% to what was expected before Liberation Day, arguably around 15%, to the announcement of averaging around 25%. Which takes us back to levels not seen since the 1930s. That is a huge shock. And actually, even though we did see a very sharp sell-off in equity markets, and we did see the backup of bond yields at that time, in many respects, the fact that the markets have coped so well with this shock so far, I think is a positive in itself and shows the resilience of where the economy was and companies were as we came into this period of uncertainty.
I think it's been very topical. I know you and I certainly have had many conversations with clients over the last couple of years about the role that bonds play in portfolios. With there wasn't a day that was going by without an email being in my inbox. From somebody talking about the death of the 60-40 portfolio. So what role does fixed income have, and as well as other defensive investments, play in client portfolios during these times and going forward?
Claire, is that something you might want to talk to?
Defensive investments, I think, are key, and it comes back to the point Lothar made earlier about diversification. So we've had a collision of politics and economics coming together that has created a whole bunch of uncertainties. And it will take, as Stuart and Lothar have both said, a long time for this to settle down and a clear vision to come through. So what can help portfolios at this time is having investment vehicles that provide a defined level of return. You know what that return is going to be, but also provides a buffer for that volatility as well. And so individualized defined return structured notes have worked very well during this period of time because they are more defensive. They have an equity exposure, but they are more defensive in that equity exposure because they become a hybrid of both fixed income and equities. So for a client, I think if you know what your return is going to be, as long as certain conditions are going to be met, and you know those conditions are a downside buffer to where equity markets largely are on a date of maturity, I think that can provide quite a lot of comfort and provide some form of certainty in a completely uncertain scenario from that perspective, and really adds into the idea that diversification is a key element to it. Lothar, I don't know whether you want to talk about Lothar and Stuart, about the opportunities that were clearly relevant in fixed income.
Well, I think the news of the death of the 60-40 were a little bit premature, particularly after yields had come back up quite considerably over the high inflation period. So I stopped on my talk speaking about the death of the bonds and that I'd done the previous 10 years and kept on stressing people, we can work with these securities now. They are providing downside protection, and while initially in this episode they haven't provided a huge amount of protection in terms of reacting in the other way to equities, because there was a bit of a rumble in the bond markets as well, the yields are still sitting at 4.5%, and should we actually indeed slide into a global recession, then they will do their trick, because then bond yields are likely to come down and therefore values of bonds will go up, and regardless of that, they are at the moment providing a nice carry asset in the portfolios, as we say, which produces an ongoing income stream that equities can't. So no, I think that the 60-40 portfolio is alive and kicking and doing its job.
Thank you to all three of you for your time today. I'm sure our clients are going to find it extremely beneficial, and I know how busy you all are, so thank you very much. And to our clients, if you do have any questions, please don't hesitate to reach out to your advisor, and we'll be back to you. All the best.
Thank you very much. Thank you.
Thank you.
Bye-bye.